Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
The subject of today's talk is 5 reasons why the stock market keeps rising while the economy is struggling. I must say, I've been puzzled now for several months why we keep getting terrible economic data coming out because of the coronavirus lockdown, many businesses struggling, many people being laid off, and stock markets around the world keep rallying, keep going up day after day, particularly in the United States, which doesn't make any sense at all because the United States, of course, has the worst record on coronavirus in terms of the most infections and the most number of people who died from coronavirus. Of course, they've got this huge stimulus package, but nonetheless, stock market prices shouldn't keep rising at this rate. So it made me go away and do a little bit of research on this to think of 5 reasons why this might be the case. Stock markets crashed, of course, between February and March 2020. But since the 23rd of March, there's been a huge rally in the US particularly, less so in other countries like Britain. But the rally has been about 40% so far, and the Nasdaq, the technology index in the US, is actually above the level it was before the crash, which is amazing. Anyway, start with the first reason. Economic data looks at the past, but the markets look to the future. It's often said that the stock market looks at the economy 18 months ahead. So just purely looking at the economic data today will not give you the true value of shares because they are priced in some 18 months ahead. The second reason for the continuing rally is that the market hates uncertainty more than awful news. We've had some extraordinary high unemployment figures from the US. You'll get a figure of, say, 20 million one day announced, 20 million job losses, and the stock market rallies and goes up again. You think, well, how is that possible? Well, it was because the market was expecting 22 million. So it's still awful news, but somehow or other markets have risen because the awful news isn't as bad as was expected. A third reason is that the low yields on bonds make it harder to avoid investing in shares. It's a strange time at the moment when government bonds and corporate bonds are producing returns, they're called yields, of near zero, in fact even the negative. The UK government recently launched a government bond for the first time ever that produced a negative yield. So when you're getting negative returns or near negative returns, it's tempting to invest in shares that can still pay dividends that can bring in several percent a year, which is better than the return on bonds. A fourth reason is that the next year of corporate profits doesn't matter that much. Now that might sound contradictory, you think it would do, because what you're doing when you're buying shares, you're buying future earnings, but you're not buying the future earnings just for 1 year. You're buying the future earnings, in other words, profits, for many years ahead. So when the long-term average measure of the value of a company on, say, the UK market is, say, 16 times their projected earnings, it's called a PE ratio. When it rises to 20 or 22 in the short term, that doesn't necessarily reflect a huge fraction of the total profits over many years ahead. That's just 1 year, one snapshot in time. So again, that's not necessarily going to affect stock market prices in the short term. And the fifth reason is the huge amount of monetary and fiscal policy measures being brought in. So far, we've seen mainly monetary measures, these huge packages you hear in the headlines in the United States in particular of several $1 trillion. The stock market has become quite excited by the huge amount of cash stimulus that's there, that's going to enable a lot more spending by governments and by individuals, and that's another reason why share prices have remained high in the meantime. Personally, I've been saying this for some weeks now, and this could go on for a long time. Personally, I think that there's more likelihood of a big fall in stock markets, but when that will happen, who knows? Markets can remain irrational for many years or many months or just many days or weeks. You don't know when it will happen, but I'm certain it will happen at some stage, and it will probably catch us by surprise, much like the coronavirus did. So do watch this space and do be careful. Don't get carried away with the stock market rally.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.